There's a tequila crisis going on.
Oh shit!
Do you know about this?
No.
Yeah.
Oh.
Wait, so how much did Jimmy pay for our bottles?
No, it's not a price crisis. It's a supply crisis. And
What's the difference?
The reaction to the supply crisis is the problematic part. So tequila became like the thing, and that happens. Like vodka was the thing in the 90s. I think single malt scotch in the 2000s. Like there's always a thing. So they can't. The good brands can't make it at quantities sufficient to supply it all over the world from this one little province in Mexico. Mm. So some of them are cheating. They are adding more sugar to speed up the fermentation process so they can get more out the door. So I guess technically you could say that it's being aged the same length of time, but it's really not. And
does that affect like the labeling of the tequila bottles? Because like every different country has like a pretty tight sort of standards process that affects labeling.
I don't know if they're faking. I don't know how they're getting away with it or what they're doing, but it's noticeable. Like my favorite brands of tequila, they taste at this point it's like maple syrup. And I asked somebody who sells like high-end tequilas on Long Island, like a guy with multiple liquor stores who's like plugged in with all the top suppliers. He's like, this ain't the shit you were drinking 3 years ago. I'll tell you right now. Like this is sweetened. So why would they screw up the taste? Because they're trying to make more and more and more. And so the more sugar you add, the faster they can make it. Or something like that.
Right.
So this is why we need to buy Greenland as fast as possible.
Yeah, exactly.
I have been saying this. Most great tequilas come from Greenland. As you are well aware.
With Canada.
As you are well. And Dos Arts is the biggest basket case. My favorite brand of tequila. They can't ship anything. Like the one that's in a ceramic bottle that's kind of square, like a rectangular ceramic bottle.
I've never heard of that.
Yeah, you have. You've had it before, I think at my house maybe.
Okay.
They can't ship anything. They're like sold out of the añejo everywhere. So it's problematic times, guys.
I remember what was it? The Avion tequila guys
from Entourage?
The Entourage guys,
Mark Cuban.
Yeah. I forgot. They sold NetJets or they sold a private jet company or
something.
That
never really took off, Avion.
I don't think it got as big as they wanted, of course, but they are still in bars.
I wonder if that was like...
Here's what happened to Avion. It had a moment in like 2007.
Yeah,
it was too early.
The last season
it was too early. It was like the pets.com. It was like too early.
Right. But then what happened was Randy Gerber, who owned the Whiskey Blue, like the big bar in Manhattan, teamed up with George Clooney. And they did Casamigos. Right. Casamigos just totally stole their thunder.
Yeah. Right.
And that became like the mass market premium tequila brand for a while. And now there are, I don't know, 100 of them. I bring this up because we were delivered 2 bottles of Clase Azul today as a gift.
Are those still good?
Yeah, quite good. Quite good.
Tasty. Not quite $86 a glass good.
And not añejo. The white and blue bottle that you see everywhere is actually a Reposado.
Yeah.
And the Reposado is better than the añejo in Clase Azul. It's cheaper and better.
I usually prefer Reposado.
Me too. It's like the 15-year-old scotch is too much for me.
Sure.
Especially the 18. No thanks. Not for me.
Yeah.
So what else is going on?
You a tequila guy?
I'm a lot of things, but like the main thing I'm not is scotch.
I'm a lot of
things, but I'm mostly bourbon, but also tequila. Okay. It's like if I'm sipping, it's bourbon or tequila, and then mixed drinks is
what's your bourbon?
I like Eagle Rare, but lately I've been drinking. This is just totally random. Lately I've been drinking Benchmark, which is basically well whiskey, but it's the cheapest. It's basically the cheapest, shittiest whiskey that the Buffalo Trace distillery makes. And Buffalo Trace is the one that produces Pappy Van Winkle and Blanton's and all these like really high.
Yeah, they all come out of that's right. They all come out of the same thing.
Is Knob Creek in that family?
Knob Creek is separate, is a different family. By the way, Knob Creek has an amazing firing range. If you're ever in Kentucky and you're looking to shoot.
I could see how those two things would go together. Like bourbon and guns. I totally get that. Breckenridge, underrated bourbon.
Yeah.
I think it's originally a whiskey distillery in Colorado.
Okay.
Breckenridge is off the chain.
Yeah.
Four Roses.
Yep. Four Roses. Yep.
Four Roses, good.
Yeah.
Okay. Is Blanton's like a top for you, or?
I like Blanton's, but like, it just shows up in so many movies that it's like impossible to get for like, the manufacturer's price. It's like, I don't know, you're supposed to be able to buy it for like $30 or $40, but anytime you go to a liquor store, they're selling it for like $180.
Pappy?
I've never had Pappy.
Okay.
But I would imagine it's kind of like this thing where like the more it's aged and the more it's refined, I'm just not going to be able to pick up on, what I'm supposed to be picking up on.
Budweiser?
Love Budweiser.
Andrew gives the thumbs
Bud
up
heavy.
to Bud. There we go.
Full on Bud heavy.
There we go.
None of this Bud Light crap.
We did an episode of The Compound of Friends with Meb Faber, and he's a huge craft beer guy. So I brought like 12 different craft beers in, and we like drank them head to head, like this one versus that one. I was stumbling out of the room. I was stumbling out of the room.
I think Meb went to see a Broadway show with his family after.
Yeah, and Meb's wife showed up to pick him up from here. Yeah. And the table was just strewn with beer cans.
It's not what it looks
That's
like.
tough.
Dan Ariely, the behavioral economist, did a great study at MIT. He took Budweiser, and he took then Budweiser next to it and added a little bit of vinegar to it.
Okay.
And they called it MIT craft beer.
Okay.
And they did taste tests.
Yeah.
And people loved it.
Yeah.
And they were like, "Oh my God, it's so great! It's like small batches, et cetera, et cetera." And then he told them about it. Right. This is one of the great behavioral studies, and then what happened was actually people were so anchored to liking it, and they were so insistent on consistency that the bartender at the MIT bar had to have a thing of vinegar behind it, because people would say, no, I want MIT craft brew, which meant buying a Budweiser
Maybe it is
and then
good,
putting
though.
vinegar in it.
But what if it's actually good?
It might be.
Yeah.
I mean, you think about like, martinis with brine and all that crap, and
people like that.
Yeah.
People like that taste.
Yeah.
I did a taste test myself for wine, not like a big wine guy. And I bought a $40 bottle and a $10 bottle. The problem was they were two different types of wine.
One was white and one was red.
Exactly.
Oh, you wanted to see if you could tell the difference between the good one and the bad one?
And one was like a Pinot and one was a Cabernet or something.
One was champagne, the other
did
was
not
champagne of beers.
Exactly.
Coming in with 3
0% chance. 0% chance. 0% chance. Today's show is brought to you by our sponsors at Betterment Advisor Solutions. Imagining a better future is the first step. Investing in that future with Betterment Advisor Solutions is the next. Whether you're launching your own practice, looking to streamline client onboarding, or just searching for efficient ways to scale your firm, Betterment is here to help. They automate to make tax optimization simpler. They provide support to make administrative tasks easier. At Betterment, they are building innovative technology all for anyone who's ever said, I think I can do better. So, grow your RIA your way with Betterment Advisor Solutions. Learn more at betterment.com/advisors. Investing involves risk. Performance not guaranteed.
Ladies and gentlemen, welcome to literally the best investing podcast in America. Dare I say the world, right?
There we go.
I don't
galaxy.
know. Do you think are there good investing podcasts in Europe that I don't know about?
I'm sure.
Not this good?
Not this good.
How many of them Sam Rowe?
Not even this close.
All right, come on. Ladies and gentlemen, the Compound and Friends, episode, what is it?
184.
184. You guys, we're in for a treat. We have a returning champion and a first-time guest, and I can't tell you how excited I am, given all that's going on in the markets, to tell you who's with me today and get into the show. First things first, please welcome Andrew Beer. Andrew is a managing member at DBI, a pioneer in hedge fund replication. Prior to DBI, Andrew started in the hedge fund industry in 1994 when he joined the Baupost Group as one of 6 generalist portfolio managers working for Seth Klarman. That's a big name. Big name. If I ask him if he knows you, will he say yes?
Absolutely not.
All right. During 1999 to 2004, he was the founding partner of 3 hedge fund firms in areas ranging from derivatives arbitrage to fundamental commodity investing to cross-border trading in Asia.
That's what Josh started.
Andrew Beer.
Cross-border trading in Asia.
We have a very similar background.
Yeah.
Also with us today, Sam Rowe. Sam is a bourbon drinker. He's the founder and author of Ticker, an award-winning newsletter covering news, data, and insights, informing long-term themes for investors and the economy. And as I mentioned, he is also a fan favorite here at the Compound and Friends. Thank you for joining us.
Thanks for having me.
All right, good to see you guys. All right, so anything going on these days or not really?
Quiet.
It's pretty quiet out there?
Pretty quiet.
Okay.
Ups and downs.
We're gonna start with this America's greed is good moment. Where did this idea come from? Whose idea is this?
Oliver Stone.
Okay,
Yeah.
it's your idea. So I went through this and I wanted to agree with like 90% of your notes,
Okay.
and I'll tell you where the 10% is.
Okay.
But tell us what's happening right now.
Well, so look, so I think I call this America's Greed is Good moment because in 1987, when the movie Wall Street came out and Michael Douglas gave that great speech about the job of the company is to make money,
Yeah.
it was very controversial, right? Remember in the 1970s, corporate America had gotten very fat and lazy. You had Japanese cars coming in the 1980s. You had sleepy corporate boards. People would build factories just because they like to build factories. You had conglomerates that specialized in mediocrity. I mean, and around that time, though, the LBO business was starting.
Yeah.
And the M&A business was starting. And what was happening is people were looking at these companies and saying, we can do better. But they were vilified for it. Like the idea of providing stock options to management teams who'd not started a company was very, very controversial. It was going to exacerbate inequality, which it did.
Yeah.
But what it also did was it actually aligned the incentives of the management, which was basically it's much easier to run a business if your one goal is to make money. You can focus on it. And it got people thinking about things like restructuring and all sorts of other things. So and remember at the time, the cognoscenti were arguing that the problem with the U.S. business community was we should be more like Japan and Germany. Literally.
What were they focused on if not making money?
Craft beer.
Craft beer. What do our customers think? What are we doing for our community? It was a much more how do we think about our employees? It was much more just diffuse. And
I think Japan was like lifetime employment, the shame of getting a demotion or being laid off, the prestige of being elevated within the company. The company was your life.
The company was your life. It wasn't about economic success. It wasn't about economic reward, right?
Right.
And so to me, just the point was that greed is good was so shocking at the time. And there was a great speech. There was an LBO guy named Sir James Murdoch who was giving a talk that I saw around 1988 or 1989, and everyone was talking about kind of the role of the company. And he said, "Look, your job is to make money.
Yeah.
Let your shareholders give it away.
Yeah.
Make more money, hire more better people. Let everybody make money. They can give it away. They can decide what to do with it."
Is that who the British guy in Wall Street was based on?
Yeah.
Okay.
Yeah.
What was his name? Sir Larry? Sir Lawrence?
Sir Lawrence
Wildman?
Something like that.
Something like that.
I can buy you 10 times over, maybe.
Yeah. Okay.
And so just the point is that, LBOs started out as the barbarians at the gate, but they've evolved into private equity.
Yeah.
Private credit was asset-based lending. It was hard money loans. It's become private. Again, they've stepped in to fill the role the banks haven't provided. So just my point is that things that are very, very controversial at the time actually ended up driving a lot of the American exceptionalism that we've seen in corporate America over the past however many years. For instance, I don't think you could get the people that you get into the tech industry if you didn't have stock options.
Yeah.
If you basically said, "Look, come here and be like what IBM was,"
Yeah.
you're going to get what IBM was.
These are like the smartest people in the country. You're not going to put them in a room and have them work 20 hours a day if they're not earning equity.
Right. And back then, the whole point back then was, and the whole kind of undertone of Wall Street was, you're taking the best and the brightest, and they're doing this unproductive thing on Wall Street. And they're buying Beamers, and they're, turning up the collars in their shirts. And so, but it was really profound what happened.
To your point, not only was it shocking, it was unintentional. Oliver Stone's a communist.
Completely.
He did not mean greed is good
Completely.
to take flight within the hearts and minds of 20 million young men who would then, eventually go on to found companies or come to Wall Street. Like, he didn't mean it as a rallying cry.
Liar's Poker was the same thing.
It turned out that way.
Right? Like,
Oliver Stone.
Cautionary tales.
They thought it was supposed to be like this big indictment in this community, but then it actually drew people in.
Liar's poker, like that's why everyone.
Wolf of Wall Street did the same thing.
Yeah, that's why Josh got into it.
People are,
it's very funny because in the movie Boiler Room in 1999, there's a scene where the brokers are reenacting not the Greatest Good speech, but another Michael Douglas scene from that movie, and Gecko is the archetype that they are striving to be. In 1999, if they're all 25, that means in 1987 they're 13 years old, and that's a formative moment for them, is seeing Gordon Gekko on screen.
That was the I'll eat your lunch one.
And I've written about this. I felt that The Wolf of Wall Street, I don't think Scorsese meant it to like glamorize ripping people off in the stock market, but I have to tell you, that movie, I think, gives birth to the types of traders who first came into the market in 2020 and 2021. Yep. And I think that that's their cultural touchstone that they grew up with. I can't wait to grow up and be just like Leo.
That's fascinating.
Yeah.
I never thought of that, but you can definitely see the parallels.
Absolutely.
Yeah.
Okay, so go on.
Well, so my point is today, right? I mean, there's been a very, very strange transformation. Whatever you think of Trump, either way, and whatever you think of
I'm MAGA like through and through.
Okay. Okay.
All right, keep going.
I'll leave mine on outside, but
okay.
But what Trump and the administration represent is unfettered, unapologetic capitalism.
Yeah, we're going to disagree on this unfettered part, but keep going.
Okay, so basically that in a sense, if you free capitalism from regulatory constraints and all sorts of other things, that you can do what Elon Musk did with SpaceX. You can take a government that needs 3 million people today or 5 million people, whatever the number is today, and you can do it with 1/7 of that. I think a lot of it is unrealistic at the end of the day in terms of what's actually achievable. It's not achievable, but it's a philosophical thing that feels very shocking today.
Yeah.
And that's where I draw the analogy without opining on whether they're going to be successful or doing it or not. It's just there is a sense of even almost a sense of like, well, it's now if we're gonna, the old model of serving the government was I work on Wall Street, I work my way up through Goldman Sachs or something, I become Secretary of the Treasury,
right,
and I'm going to bring my experience, but it's all incremental.
The Robert Rubin method.
Exactly, right? And there's a long history, and there's almost noblesse oblige.
Yeah,
right. And these guys don't care. Right? They
definitely don't care.
There is no Sir Elon Musk in the future, right? They're impervious to public criticism. They are willing to have open failure. They're willing to have things break.
Yeah.
It's a huge philosophical change relative to anything we've ever seen. And so my point is just that what it's doing is it's stretching out the range of possibilities right now.
Right.
3 months ago, it was, this is animal spirits. It's going to be great for the economy. It's going to lift all boats. It's wonderful. Now people are like, oh my God, things actually might break, or kind of going back and forth.
Yeah, the Overton window has been kicked completely out of the frame. We're no longer shattered. We're no longer talking about opening the aperture wider. Right. Now, the realm of possibilities of how far these policies can go, what the second order effects may be. Yep. Everything and anything's on the table.
Everything's on the table.
I think that's a really good take. I agree with that.
What point that Andrew made do you disagree with?
The unfettered capital. This is not unfettered capitalism. This is literally the president saying, write a check for my inauguration and I'll let you do your next merger. Make your platform more amenable to my most hardcore supporters in the, let's call it, alternative media, and I will find ways to include you in the next, government contract. Like that's not unfettered capitalism. I understand that people want
it's cronyism.
It's cronyism.
It's venal, right? It's venal in plain sight.
And by the way,
right?
The Clintons did it too. So what I'm saying is not coming from a partisan standpoint. The Clintons had this bullshit called the Clinton Global Initiative, right, which was effectively a patronage network, not unlike what we've seen, in New York City in the 1800s with Tammany Hall. Okay, everybody does this. They do it in Chicago, the Democrats. Trump's doing it in D.C. and all over the world. But let's not call it unfettered capitalism. It's the same picking winners and losers that the other party does. Only this time, the people that are being picked and favored are, in many cases, the enemy of the media. So the media is much more angry about this than they ever got about whatever the hell Hillary Clinton was up to.
I think in terms of how it actually for the venality in plain sight is something new.
Well, they're not hiding
It's more
it.
brazen.
They're
It's
not,
more brazen.
they're not
It's right.
hiding it.
Right. And that's why. And I think there are people who are going to the administration who think, "Hey, I'm worth $1 billion.
Yeah.
I'm willing to drop my day job, come in and save the government." And I think in their mindset, which is exactly the greed is good mindset, hey, if I can privatize Yellowstone National Park, I deserve a cut.
Yeah.
Right. Like, I mean,
Batnick was talking about this with Friedberg and Chamath, talking about like the strategic reserve.
exactly.
Not Bitcoin, the wealth creation thing that we're going to do. If we're going to do a deal with Pfizer, we should have warrants. I mean, he said that out loud.
And that's
a philosophical thing.
And that's what I mean about the stock options, right?
But a lot of people would
stock
say-
options were viewed in the same way in 1987, in 1988. It was they didn't earn that. What do I mean if the stock price goes up? They don't. I'm not taking position either way.
Yeah,
I'm not.
me either.
But it's having been there because I'm probably the oldest guy in the room and having seen it. It was. There was a guy named Mike Jensen at Harvard Business School who wrote.
I don't know.
Okay.
I don't know. He was telling me about the courtship of Eddie's father the other day.
Okay.
I don't know if you're the oldest guy in the room. Hey, can I ask you a question? You agree with this? I want to hear what you think also. There are 40 million Americans who would answer back and say, I assume they're all stealing, both parties, every level of government at all times. I really don't care as long as they get the Venezuelan gangs out of here and I get to say the R word. Like people, honestly, most people really don't care about these things. The media is up in arms. Maybe there are some really highly principled people on Wall Street that are somewhat offended by it. But honestly, people just want their stocks to go up, their house to be liquid, the price of groceries to go down, and you guys go steal whatever you have to.
Look, we have the senior administration communicating on Signal.
Yeah. No,
Okay?
it's totally normal. I love it.
That's totally shocking to beyond shocking. And the same people who were on Signal were demanding people get thrown in jail for communicating for not being. I mean, but there's maybe it's the unapologetic part of it that I find fascinating.
Yeah.
That the standards are very different than what they were. Like, in terms of what you're saying, look, I think most people are concerned about their day-to-day existence.
Yeah, that's what I think.
I think that and I think what you have on the media side is, the 11,000th moment of shock again and again, where, oh my God, there's, somebody is saying something that is dishonest. I don't think that's shocking to those 40 million people anymore.
That ship has sailed.
The sovereign wealth fund, I think people would love that idea. Like, wait, again, going back to Pfizer, if we're going to buy all their vaccines, we should get upside in that. I think that the average American would say, like, isn't that how it should work?
Okay, but that's not unfettered capitalism.
I think there's this greater theme of, regardless of the state of the economy or the stock market or whatever, you have record high stock prices, you have, unemployment at 60-year lows and all this kind of stuff. For better or for worse, I think the American people or consumer, whatever you want to call it, are just never satisfied with the state of things. They always want things to be better. They always see everything going wrong in their life, even though there's a lot of things going right. And so, I think it kind of ties into this whole, sort of greed is good messaging, in that, like, because you're never satisfied with how good things are, you'd rather just destroy, the state of things because you think that something might be better on the other side of it. It's sort of like a sort of a collective grass is greener moment.
Well, people also take it for granted, right?
Oh, for sure.
I mean, we have generations of people who've grown up without going to war, right? Without being confronted with it. I mean, that's why during the first Trump administration, I was less concerned about, a breakdown of democracy than most people I know, because I believe in the robustness. Again, as you mentioned, second and third order effects, right?
Yeah.
Something happens. 2 years ago, Trump was sitting in a dusty courtroom a couple of miles from here, right? That's not autocracy the way that we think about it.
Yeah.
Autocracy is your political opponents get arrested in the middle of the night or thrown out windows, right?
Yeah.
People do revolutions when they don't have food, when their lives are at risk. I mean, my partner's in Paris and we do a lot of business in, like, political fighting here is still child's play relative to Europe.
Yeah.
Right? So anyway, I'm less concerned about the left fat tail being somehow the collapse of democracy, because I think a lot of the people that Trump has surrounded himself with, which is in a sense, I think a huge head fake on his original constituents who got behind him, I think they're great optimists.
Yeah.
I mean, if you'd do an exercise 2 years ago, if you'd said, you know what, there's a candidate where Elon Musk, arguably the greatest single businessman of the past 100 years, was willing to drop things, arguably, okay, was willing to go spend a meaningful amount of his time to try to save trillions of dollars, and the outcome of that was he was going to make another $100 billion that he otherwise had. Again, I think most of those 40 million people were like, I don't care.
Yeah, I agree. I agree with that, and that's why it's gone on as long as it has. But I wanted to ask you guys, one of the things that's creeping in, and it's still at the edges, and I don't think the average person is waking up and thinking about it. We tell ourselves this story where the reason for the hegemony of just global capitalism, the reason why it's centered around these Anglo countries like England and the United States is because of the strong rule of law. It creates an environment where you can do business. You know what the rules are. You don't have like some bureaucracy that can step in and cancel deals. You also don't have people getting away with things. And I wouldn't argue that that's totally broken down. But the threat of it breaking down, there's a consequence to the multiples that we're willing to pay for stocks. There's a consequence to who we're willing to buy bonds from. I don't think that's a front burner issue right now. But what I would say to your point is Trump has surrounded himself with people who have the most to lose if there were to be a loss of trust in our markets and in the business rule of law. Like, they are the wealthiest people with the most assets. There's no way they're rooting for that.
That's what's so interesting
trust.
about this, because I think early on there was sort of like this discussion about stock market vigilantes, right?
Yeah.
Like if the market reacts negatively enough, or the fact that he is surrounded by people who have so much exposure to. I mean, it's literally the CEOs of the Mag 7, are in the front row of the inauguration.
Yeah, Zuckerberg was there, Bezos was. They were all there.
Yeah, and so it's so confusing to see like all these announcements about tariffs that are almost universally agreed on as a negative to, especially publicly traded companies that do a lot of global commerce.
Yeah.
Or maybe it's the case that they're all in on the same game. But yeah, there's a lot of conflict there, because I would have assumed that you wouldn't have this kind of rhetoric that's so unfriendly to the market that breaks down the confidence that's behind the market, right? Like the idea that rule of law and that contracts hold and that you don't have to worry about your American trading partners or whatever. But that's where we are right now.
I think the market is looking past this for now, and it is confusing for the average person who's either, even if you're in the middle or you're somewhat moderate. I don't know if that exists anymore. You have people that are like freaking out, like, how is the market holding up? It's going to collapse. He's going to break something. And then you have other people saying, well, yeah, maybe like it'll be rocky and then things are going to be so much better than the other side. We've got AI and productivity. But if you look at like just the analysts, and these are not partisan people. You have the chart 3, John, please. There's a chart from FactSet, S&P 500 buy ratings. It's at the highest level it's been in a couple of years, which is pretty remarkable. We've got consensus expected earnings estimates still at all-time highs. Next chart, John. Like this, sure, we had a mini VIX spike and the market wobbled, but wobbled. We were up 20% back-to-back years and had a 10% drawdown. That's it?
One thing, the first slide, let's not forget that, all these analysts giving these ratings have a lot of career risk and all kinds of different interests in mind. Like, as you can see, there's always, most stocks are always, have a buy rating, or most analysts, give a buy rating. So, it tends to pick up when prices are going down, right?
Which is exactly how it's playing out now.
Yeah,
because spiking as the market's falling.
For better or for worse, they're going to be anchored into whatever their fundamental analysis is saying in terms of price target. So when the price comes down, the buy ratings are going to go up. I mean, that's exactly what happened in 2022, right? I guess the buy ratings actually came down.
Well, John, chart 5. But even still, you've got bottom-us EPS actuals and of course estimates. they're not incentivized to do this, but like they're still ratcheting it up higher.
Estimates have just come down for full year 25 from 12, correct me if I'm wrong, from 12% to 7% and falling fast.
Strategists are getting bearish.
Yeah. Well,
No.
Well,
These are bottoms up earnings estimates. 12 to 5 is a lot. 12 to 7 is a lot. You agree?
Yes.
That's like very rapid.
I mean, and I think that would certainly explain, the pullback in the stock market.
I think it perfectly explains it.
Yeah. So you have sort of two competing narratives, right? So the expectations are definitely getting a little bit more cautious, but like what this is telling you is it's not, outright disastrous in terms of the expectations. All they're saying is that we went from pretty bullish to a little bit less bullish because we're still expecting earnings growth in 2020.
So that's my point.
But I would say, all the talk about tariffs is scaring the daylights out of people, right? In that, I don't think there's anybody else. We cannot separate the signal from the noise on it, right? I'm going to tell you a very, very funny story about my one encounter with New York real estate, which is where I think, but it describes this. So I looked at doing a deal about 20 years ago. It was a complicated deal. I didn't know anything about real estate. And I got introduced by a top New York real estate lawyer to one of the developers in New York. And I went in and presented the deal. And they trashed me for 20 minutes to the point where I got up and walked out. I'm like, this is crazy. I called the lawyer back. And
trashed you in why?
What are you, some little Harvard Business School guy? What are you going to pull out your HP 12C and tell us how to? It was it was personally insulting. It was professionally insulting. And I walked out and I called the lawyer and I said, Larry, excuse my French, but what the F was that? And he said, well, tell me what happened. And I told him, he said, wait, those 3 guys were in the room for 20 minutes. They're dying to do the deal. And I said, Larry, look, it was an idea. I'm not going to do it. I said, just tell them thank you. I want to be polite. Tell them thank you. Walk away. I got a call back from 3 days later. They loved your response. He's like, he's our kind of guy. Now we know he's serious.
All right. So it's a test.
And I'm like, literally, no, it's not. I'm not negotiating here. I'm not going to do the deal with them. 2 weeks later, this went back and forth. 2 weeks later, I got a shark in my office. They were calling me the shark because they thought my simply not wanting to do the deal. They couldn't imagine that I was walking away from the deal. It was everything was a negotiation.
Yeah.
And then he started telling me stories about like people in New York real estate who will invite somebody to lunch and then put their lieutenant 2 tables away and not show up and see how long the guy stays there. It's the amount of head games that goes into that world in particular. So the lens through which I look at Trump is it is truly impossible to signal to try to figure out what's the policy signal underneath it versus what is, the answer could be you'll include the Melania coin in your sovereign wealth fund.
It could be anything.
Is the answer to solving the fentanyl crisis. They're all unrelated.
You'll book someone's wedding at the hotel or at the golf course.
I think this also speaks to a lot of the analyst estimates too. Like one of the more popular phrases from the Q4 earnings calls and earnings announcements that wrapped up a couple weeks ago was, we have not factored tariffs into our earnings guidance.
Oh, well, good luck.
So what do you do about it, right? So the current guidance is basically assuming some sort of status quo because, you're supposed to take him, seriously, not literally.
Right.
But if stuff actually gets enacted and it starts to affect business, or even if it doesn't get enacted and it starts to affect business, then you're going to start to see it come up in earnings guidance.
Here's a note from RenMac to that point. Neil and Steve consider the tariff threat as more of a dial than an on-off switch. We expect Trump and the administration to fiddle with that dial well beyond April 2nd. So basically, it's like an ongoing negotiation that never ends. And this week, it's 25%. And hey, we had a great phone call. Now it's 10. If you're a sell-side analyst trying to come up with estimates for Stellantis, I don't know how you do that.
But don't you think the market, or don't you think that Trump blinked as a result of the market's reaction? Last week he said, tariffs, we'll see.
I think that's part of the reality show, though, is the twists.
Right.
So I think it's part of the show.
So there is so much uncertainty. Like literally nobody knows.
Well, and this is where you get into business planning. Right? Who's going to hire? Who's going to do anything now? Right. Who's going to make long-term investments now when you literally cannot? I described it to a friend as it's like, you get on a plane coming out of a storm and everyone's like rattled, kind of stumbling off the train because you've been bouncing up and down. It's like, it's nerve-wracking to try to think about anything beyond an incredibly near-term horizon because 3 months ago we could not be talking tariffs at all, as you say it. And so I think right now the market is assuming that this is noise. and that
You really do? Like we're in
so.
we're in a 10% correction right
that's
now.
nothing. The
I
market
think
is
the market thinks it's
It
noise.
could be. It's also. It's not just noise, but there's also the possibility that any tariffs that get enacted are very short-lived, right? Like
Well,
something
that's
happens
been my base case this whole time is that.
If you zoom out
But
and
I don't
say,
know.
if you zoom out and say, is the market super concerned about Trump's policies, and you zoomed out, you'd say, no, it's a blip. I'm not saying that it can get there, but right now it's looking past it.
Well,
and so is the bond market.
And back to the second and third order effects, right? So okay, so we throw tariffs on everybody. They're going to throw tariffs back on us.
Well, that's already,
and then he's going to triple them.
Yeah,
and they're going to triple them. Like it's an insane downward spiral that nobody's thinking about. Back to your point, nobody's saying like, well, that's likely.
So here's how stupid this is: we do tariffs against Europe. You know, what we sell in Europe is software and services and financial shit, and it's like a 50% profit margin. The stuff Europe sells to us is a 5% profit margin. They sell us Volkswagens. They're breaking even. They sell us Porsches. They're not making any money on any of this. A lot of people along the way are making money. That's not the same as selling software at a 50% margin. Why on earth would we want to upset an apple cart where the stuff we sell around the world, services, are so profitable, and the stuff being sold here is razor-thin profit margins? It just doesn't seem like, even if we got the outcome Trump seems to want, it doesn't seem like we win. Oh, great, we get to manufacture more things that have a 7% profit margin, and the rest of the world stops buying our software? Who wins in that? It doesn't seem like it doesn't seem like we win anything.
That's what I'm saying. I don't think any of the people around him. I think this is one of those issues that has some sort of political driver behind it. I mean, he has surrounded himself with some people who, from what I understand, are believers in tariffs, but I don't think the Elon Musks of the world. You
think Bessent's a believer in tariffs?
I think he has to twist his mind into a pretzel to become a believer.
There's no way.
I think he and Lutnick Lutnick, I'm less sure about it, but I think they all I think what the Trump administration is doing now, which they didn't do the first time, is they've unified messaging.
Mm-hmm.
Yeah,
right?
They're really good at it.
Right? I mean, it's normal to use Signal. No, it's not. Right?
Yeah.
But it's the adoption of Trump's Roy Cohn approach to everything, which is you don't concede anything and you punch back as hard as you can.
This is Ricardo Hausman writing at Project Syndicate. He's an international trade expert at Harvard. U.S.-based companies like Apple, Google, Microsoft, Facebook, NVIDIA, Johnson & Johnson, and Tesla leverage their innovation-based market power to extract rents from consumers and businesses around the world. If these firms were hit with the equivalent of a tariff, they would not be able to pass the cost on to their customers abroad. After all, if they could have raised prices without losing profits, they already would have done so. If we multiply American companies' foreign earnings by 26, which is the average PE ratio of the S&P 500, the value of U.S. investments abroad can be estimated at $16.4 trillion. By contrast, foreign companies operating in the U.S. earn just $347 billion in 2024. So we've built this value on foreign earnings of, if you use a PE ratio, like 16 trillion. Europe is making a few $100 billion. How are we losing in that in the status quo?
That's what I said.
It seems like we're not.
But I think the market is saying the base case scenario is nothing's going to happen.
Yeah.
Right? There's going to be there's going to be noise. It's going to always be on the front page of the news. But ultimately, you know, you're because of what we've seen about, you're not going to see a Mark Zuckerberg or somebody else stand up and say, I think this is insane. Stop it. It's going to have to be in a way where they shift the narrative. They talk about something else and they claim victory.
Yeah.
Right. There's no, and I think that's the problem with the media and the way they approach this is that it's like a 1980s like high school flick where like the bully at the end of the day is like, I'm sorry, I shouldn't have been mean to you. Or like, it's not going to happen. Right. It's not, there is no concession. There's no moment of concession. There's no acknowledgement. It's
okay.
Just,
if the media stops talking about tariffs, though, Wall Street analysts won't. So it's more than just immediate. Like, I get what you're saying. You're saying if everyone just calms down over it, he'll get bored of it.
No, I don't think that. He's gonna go on his normal path, and he's going to look. And we don't. The second and third order effects may be good for all we know at this point. Like I said, it's like what's happened with Europe with defense spending.
Yeah,
it's hard to argue that's a bad thing that's
I think
happening
it's great.
economically, et cetera, et cetera. Right? So we don't know. We just don't know what the combination. We don't know the motivation of the first order effects. We don't know how the second and third order effects will play out, and we don't know how it'll be resolved.
Yeah.
And I think this is one of those things where there's the known unknowns and the unknown unknowns. I think the market is saying like it seems so destructive to take this to its logical conclusion that's not going to happen.
I agree. So I'm gonna just say I think the typical person who is not a Wall Street finance person trading shares of GM is perfectly fine with what's happening unless it's directly affecting them,
right,
which is not a huge number yet that have really felt the effects of this. And in the meanwhile, the number one thing that you have to admit about Trump, whether you love him or hate him, he's doing exactly what he said he would do. Today, they arrested the number 3 guy in MS-13. They ripped him out of a house in Virginia. They put it on TV immediately. They're getting rid of a lot of the regulations that annoyed people. It started with plastic straws, and we all laughed. But in the meantime, every day there's more news about different departments in government where they're cutting regulation. I know everyone doesn't love that, but I think the people that voted for Trump, they love it and they're getting it. He's really doing it.
But I think for the Democrats' perspective, right?
Are there any left?
Well, I mean, like for the Democrats' perspective, like, pick your battles, right?
Yeah.
I mean, your battle is not the government was functioning perfectly the way it was before. That no one thinks that. But on the other hand, focus on the essential things that we want to preserve to make sure there's not a bad impact on people's lives. Focus on the fact that this vilification of every government worker because they made a choice to go work for the government is very, very damaging to the social fabric of this country.
Yeah.
There are people been dealing with the government the whole career. There are people who are wonderful who work for the government. It's just the career path that they chose. And there are people who are very, very difficult. And it's but in a sense, it's the same way that the arrogance of the, kind of sort of Washington geopolitical establishment about free trade and ignored the consequences that it would have to the families, the multi-generational families in an industrial city.
Well, that's the part that Trump is right about. It never was free trade. We called it free trade. In reality, U.S. goods were being tariffed everywhere. So
I think he's probably
that's
right
the part that he's right about.
Yeah.
And I think, again, to bring it back to investing though, like I think the chaos might be part of the point because of all the attention it gets.
But the market is looking past it.
I don't know.
So
I think each week we're losing a little bit more ground, and one week it's going to be a really big move.
You might be right, but in times of like heightened uncertainty, I defer to the market. I think the market knows more than any of us collectively. I mean, obviously, it doesn't mean it's always right, and this could age very poorly. But for now, the market is looking past it. So Morgan Stanley's Andrew Sheets was quoted in the FT this week. And he said, we're mindful of the temptation for equity investors to take comfort from the credit market's resilience. Yet, remember, 2 of the big issues that have faced stocks were not really credit stories. So then later in the article, they quote Greg Obenshine from Verdad Capital. And Josh has been talking about this, that maybe it's not showing up in credit spreads because really we should be looking to the private credit markets. But even then, they say, while the private credit markets has experienced rapid growth in the past 10 years, the high yield market is the same size as it was in 2014. Pretty interesting. Furthermore, over the same period, the share of double Bs, which are the highest rated portion of the index, has climbed from 41% to 51% of the high yield index. Giving credence to what Josh has been saying, it's like, if you're looking there, it's more highly weighted than it used to be otherwise. However, even the chart on, please, John, chart 7. Then they go, even the junkiest of junk. So forget about the double Bs. Even the junkiest of junk, we're looking at triple C and lower, remains sanguine over recession risk. So there was a little bit of a spike, but to call it a spike is hyperbole because it's still below where it was for almost all of 23 and all of 24. So unless this starts to pick up, I have a hard time being too worried.
This doesn't look like starts to pick up. That's exactly what it looks like.
Yeah, I mean, it's like, on one hand.
But it was on the floor.
On one hand, you have the whole,
still,
it happens slowly and then it happens suddenly kind of thing too. But, don't forget, we also spent the last couple of years talking about how much credit quality has improved with a lot of these companies we're talking about.
Right, so all of a sudden that's different because of threat of tariffs?
Yeah, no, I mean, like, I think the threat of tariffs or like, higher costs or lower revenue and all this stuff, might, be a problem when it comes to earnings growth, going from earnings growth to slower growth, or maybe you have some earnings declines. But I'm not sure anyone's like saying, well, we're in a situation right now where we're having actual financial distress.
Nobody yet.
Nobody. Because again, credit quality, cash balances, all this stuff is very high. Profit margins are
Did
near
credit
record
quality
high.
get better, or
Yes,
or was there just so much money available that nobody could actually default?
I mean, what's the difference?
The companies themselves probably aren't better, but the Treasury and Fed printed $4 trillion and rained it down on everyone.
Margins are at all-time highs across the board of almost every company. Not every company, but across
Even
the
when
board.
you look at issuers in the junk indices?
I don't know about that. Those are never highly profitable companies. But my point is, I'm not dismissing risk. I'm just saying that for now, the market seems to be not super duper concerned. And again, maybe it's wrong.
Yeah, I mean, if this stuff persists, then yeah, it could probably turn into a problem because, I mean, that's another thing that's sort of like, you balance, is this a good or bad thing? That, so many of these companies have shifted toward long-term fixed debt as opposed to a lot of short-term floating rate debt.
Yeah.
So it's like, this might not affect companies for the next couple of years, but if rates stay where they are or they creep up more, then, maybe you do have a problem, especially if growth goes sideways.
Do you worry about like the wall of maturities or like the amount of private credit expansion and how much more important those types of lenders have become relative to the traditional banking sector? Is that like on your radar as something to worry about or not yet?
I would say with respect. So first of all, I think in any area where you throw tons and tons of money, people, and you give them an incentive to put the money to work, you're going to have people are going to take more risk at lower yields. I mean, a great case study would be to talk to a typical buyer. What was your experience doing a loan today versus 5 years ago and 10 years ago? On the other hand, there's not the contagion risk, right? I mean, private credit funds can lose money, but they're not leveraged. Nobody's calling. I mean, yes, maybe some of them have a little bit of leverage built into them, but you don't have that. I mean, in a sense, you've actually decentralized a lot of the.
They're not tied to deposits like at a bank.
Short-term deposits, their money runs. There's no Silicon Valley issue here. So I really don't know the answer to that. I mean,
I agree. I'd rather Apollo take the risk than Bank of America.
And those guys.
I agree.
And those guys are, again, Apollo, Blackstone, Ares, Sixth Street. Right. These are some of the greatest investors, allocators, like businessmen.
And the top six issuers are responsible for 75% of all loans in private markets. So you're already seeing the payment in kind stuff pick up. But you're right. Like Blackstone can probably take these companies through. There is almost infinite money. Now, I know the spigot, when it turns, it gets dry very quickly. But for now, I would rather it be in their hands than syndicated all over the place.
Well, because I would have said before in the 2010s when you were looking at normal issued bonds, my argument about it was, okay, so you're going to negotiate those bonds, and you find out that Apollo owns your bonds. I mean, that's the worst day of your career.
Why?
Because they are so tough.
Okay.
Like Apollo, Ares, or whatever. It used to be if you're negotiating with a bank. Banks have ongoing business they're worried about, that whatever. I mean, these are such hardball negotiators. They always leave the room more than anybody else. So
this is that creditor on creditor violence we hear so much about.
Right. And that's when they're inflicting it on each other.
Yeah.
Imagine if you're a normal corporation or a normal corporate board. I mean, it just so anyway, look, I think they're responsible stewards of capital. And I think they're aware of the historical precedents of taking on too much leverage and stuff. I don't see it. I'm not an expert in the overall industry landscape, but I doubt that's going to be.
I guess but the question is, like, if there's really so much, Michael might be right when he says that the markets are looking through a tariff-driven recession, because if there really were as much concern as people say they think there is. Why is copper making a record high right now?
Why is the 10-year at 4? Why is the 10-year at 4.3?
Right. Why is the 10-year at 4.3? Why do we not see spreads blowing out really anywhere? Because there isn't any distress yet. So it might just be it hasn't gone on for long enough. Might be the right answer to that question.
Or we haven't been surprised by second, third order effects, the unintended consequences, and all that kind of stuff. Everything because like you were saying, that a lot of the stuff that's happening is stuff that Trump has been promising for a really long time. And so, as much as there's volatility in the markets, a lot of companies will tell you that they've already been, setting aside a plan B for, all these different things that could possibly happen. But, none of that stuff will ever capture, let's say Europe decides that they just hate America now, and then all the consumers there decide that they're not going to buy American branded products anymore. Like, okay, then maybe you have bigger problems. Not that I'm not saying that's going to happen, but it's really disturbing when you watch like a Canadian hockey game and like people are booing the national anthem.
It's not great. But also,
I'm going to Montreal next week. See you later, guys.
The hard data is not softening yet. I mean, it's not as strong as it was last year, but initial jobless claims, people have been waiting for that to spike. Maybe it will. It hasn't yet.
But I mean, Trump has an extraordinary nose for power, right? And he recognizes that the U.S. is still, and however you think about it, the most powerful nation in the world. You don't want to counterpunch on a trade war.
Yeah.
You want to concede what you can concede and slither out of the room as fast as you can to avoid getting into a major escalation.
But you said this. He's going to declare victory before anything happens.
He already won the trade war. It doesn't matter. Right. But Apple and NVIDIA are two pressure points that the Chinese, if they wanted to, could really push on. Apple is hugely reliant on China, both as a place to sell phones, but also as a place to manufacture. And you could see it hasn't happened yet, and it may not happen. I hope it doesn't happen because it's the second largest market cap in the United States of America. But the Chinese are very well aware if the iPhone disappeared tomorrow, there are plenty of Chinese phone makers who would fill that void. And if they really wanted to put the screws to our stock market, pushing on that Apple pressure point is a pretty easy thing to do. You don't even have to do it. You could just talk about it. That's one. Two, now they're sort of waffling on the NVIDIA relationship with China. They're saying that all of this AI stuff happening with NVIDIA's chips is not great for the environment. These are hints that they're dropping. NVIDIA and Apple are massive pressure points for the entire global economy and very acutely the United States stock market. And that hasn't really been tested yet. Do we want to know what the NASDAQ does in that scenario? Do we want to guess at what the S&P looks like if that becomes the new theater of the trade war?
But I think that's why the market's ignoring it or largely looking past it because they see this. I mean, usually when the market freaks out, it's either something big happens overnight that nobody was expecting.
DeepSeek.
Or it's three things that converge at once. So last July it was the bizarre political stuff happening here at this because again it was like everyone thought Trump was going to win and he was going to face Biden. Then overnight Kamala Harris was put in, which everyone thought would be worse than Biden. All of a sudden, she's doing really well in the polls. So all of a sudden,
stock market didn't love that.
Animal spirits. Stock market didn't love that. At the same time that Powell comes out and talks about weakness and you get a number of data points on weakness in the economy. At the same time, the Bank of Japan comes in and decides to blow up the macro world, and so it's usually convergence of things like that.
It's either a shock or it's an in threes thing where the market sits up and says, "Wait a minute, all of this sounds bad."
Right.
Yeah, I agree with
that.
It's a good way of framing it.
And it kind of builds on it, right? And so, to me, it would be, it's less likely that there's going to be a visible escalation on the tariff front that results in kind of mutually assured destruction on the economic side. It's more likely that while that's going on, there's a bond market tantrum in the UK that causes something bad to happen there, and that same week, some bank that nobody's heard about goes under at the same time, or it's going to be it's usually, and then there's a new virus. I mean, there's going to be it's always something weird where people don't know how to price it initially.
How about a $40 billion IPO that nobody wants to buy?
Just
that would do it.
Yeah,
that would do it.
Would that do the trick?
That would do it.
Because that's what I think happens tomorrow.
I don't know.
By the time people are listening to this, I will look like an idiot, or I will look like, or I will look like George Soros.
Okay. So for right now, it's still a political story, right? Like it's more of a political story than a market story. If you look on who's on the talk shows, the political shows, it's not markets people yet. That's when you know we're in some shit. When Jim Cramer's on,
I agree with that.
When Jim Cramer's on Bill Maher, then it's a market story. For now, it's a political story.
They're not calling me yet from CNN,
right?
Okay.
And that is
there were a couple of days close to whatever the bottom was when we entered that 10% correction that there was a couple of folks.
Yeah, we might get there. Josh might get the call.
Yeah.
I might get
Don't worry.
Well,
stand by. Stand back and stand by.
What I always say is...
that's another thing too, right? It's like, as much as we're going to say that it doesn't look like the market's taking this very seriously, well, these corrections can happen for over a very long time.
Totally.
Right?
Totally.
But there's one...
Hold on. What I always say is about that, you never do the first markets in turmoil. So I'll usually when there's going to be a markets in turmoil special. So this is at 7:00 at night on CNBC when they would normally run like Shark Tank. If the Dow is down 1,300 points or something, they'll call for a markets in turmoil, and with good reason. That's when people like actually are paying attention. You got to have something there for them. But you never want to do the first one. You always tell the producer, "I'm not free tonight. I'll do if you need me tomorrow night," because that first day of markets in turmoil could be reversed so fast, and then it's like I just spent an hour last night like doom scrolling with people, and so you always want to wait till the second or third edition.
If you need a crash tomorrow, I'd be more than happy to put a Twitter post up saying I'm not worried about a crash.
No, we don't need that. yeah, we're good.
I just went all in.
Bye.
We're good. All right, where are we going next?
Andrew, you've got some opinions on the ETF market specifically. Let's talk liquid alts. Go ahead.
Sure.
The mic is yours.
Well, thank you. So
Can
I
you
think
define liquid alt for the audience that's not sure what that term means?
sure. So liquid alts was a term. It's a terrible term that came into existence in the early 2010s
I
after
hate it
the
so much.
GFC.
Yeah.
And basically, the idea was there are alternatives, which means generally it meant things that hedge funds do. So you don't just buy stocks, you also short stocks, you make macro calls, you might go long and short different fixed income instruments. So kind of the bread and butter of what hedge funds do inside hedge funds. And hedge funds are vehicles that a typical investor cannot get access to unless you meet certain net worth accreditation requirements, and they're kind of a pain in the ass and tax inefficient, all sorts of things. So generally it's the realm of institutions and high net worth investors. So people came up with this idea after the GFC where a number of these hedge funds did well, and they said, well, these would be great. Let's take them out to the retail world, to the everyman investor, and we'll take the same kinds of strategies.
They had great 3-year numbers because the 60-40 portfolio in 2008 looked horrible.
Yep.
And so if you were doing something that deviated from that, you looked better in comparison. And on Wall Street, the number one rule is you sell what people want to buy.
Yeah, and you look at 1,000 funds and you find the 50 that have done the best,
And then
and
that's
they're
your
unrealistic,
benchmark.
and then you
That's
go
your
pick them,
benchmark.
right.
That's your track record.
and so they package them in mutual funds to make them more accessible to people. It's generally been a catastrophe for investors.
Yeah.
So since they launched, they've done about 2% per annum during one of the great bull markets ever, and that's after about 200 basis points in fees.
Yeah.
So I'm in a kind of I'm in sort of an unusual position. I think that there are some things that hedge funds do that can be very valuable for the typical investor, but I am hugely critical of the vast majority of stuff that's been created where I don't think there's any real value that they've offered to investors. But they have made a lot of other people rich.
Is the problem the mutual fund wrapper itself, or is the problem that once a strategy is done really well, whether it's a liquid alt or a hedge fund, the strategy is going to become so crowded that the alpha is not going to be enough to go around? Which is the bigger issue with liquid alts?
Well, I would say honestly it's both, but the mutual fund wrapper has been a very big problem. And in 2013, I wrote a paper with a professor at Columbia basically saying people are radically underestimating how hard it is to take what hedge funds do and make it work with daily liquidity, all sorts of other constraints. You couldn't kind of go on this list of things you have to do to make it work. And I described it as taking a great mixed martial artist and asking him to use his feet, basically. Yeah. It's just not going to work as well. And we were right. It didn't stop the business from growing to hundreds of billions of dollars because the typical firm in this space has what Ben Johnson at Morningstar calls a spaghetti cannon. They shoot a bunch of crap at the wall and they hope some of it sticks. And whatever sticks, whatever's doing well,
they'll make 10
they
of them.
Unleash their army on you.
Yeah.
And that's the only one you'll hear about. You won't hear about the ones that did badly. And so it's very much of it has historically been an area where products are sold. Because again, going back to your boiler room analogy, you got a 200 basis point product. You can pay your salespeople a lot more than going out and selling a 25 basis point.
Not only are you paying the brokers more who are selling this to middle America, but also it's giving the brokers an aura of sophistication.
Yep. Just
being able to talk about it versus having the conversation like, well, what do you do that's different than Vanguard? What do I do? How about private credit, motherfucker? Can I show you? Can I show you? And then, of course, they'll pull out whatever the best track record is, and they'll sell. And they'll sell that.
I mean, the average advisor has, I think, two major strategic issues at this time. One is you're competing with Vanguard, right?
Yeah.
It's absolutely bizarre that one of the two largest firms in this industry is a nonprofit, right? I mean, imagine if Steve Jobs set up Apple as a nonprofit, what that would have done to the tech industry and how weird, like your iPhones would be $7.
Yeah.
The other is that 60/40 stopped working. A lot of the asset management business was built on a peculiar statistical relationship between stocks and bonds in the 2000s and 2010s that has not been working.
Wait, what do you mean it hasn't been working? I mean, it didn't work for 1 year.
It didn't work in 2022.
It didn't work in 2022.
2023 and 2024.
How didn't it work?
When you say worked, what do you mean exactly?
Providing meaningful diversification benefits relative to equities. Okay, so I start from the assumption that if you want
those are bull market years. It shouldn't work. Meaning, like, bonds are a drag on stocks in 23 and 24, and rightfully so, because stocks did 20% plus in both years.
Well, okay, I would frame it the other way. I would say in the 2000s to 2010s, you literally didn't need anything other than bonds.
That's true.
Okay, bonds did 350 basis points more than cash, Sharpe ratio 0.9, volatility of 3, right? It was a straight line to the upper right. Negative correlation to equities, never went down more than 4%.
Yeah. Great decade for bonds.
If that was a hedge fund and whatever, all you should have done is in 2000 you should have leveraged up bonds and forgot about everything else.
Which is why I did that.
Okay. And that's why you own this building.
That's right.
Since then, right, vols have doubled. The max drawdown has quintupled.
And on a real basis, forget about it.
Right. And it's underperforming cash, negative Sharpe ratio, and it now has a correlation to equities.
So you're looking specifically at the fixed income piece, whereas like Michael and I are always biased toward the equity piece.
Right. I mean,
that's the way we think. That's the way we think.
You start with 100% equities.
Yeah.
And then you say, how much do I want to peel off?
That's right.
To sleep at night.
10, 20,
right.
30.
Buffett would say, give me 95% equities, give me 95% S&P 500. I've got 500 people, going back to this options discussion, who are going to go to the office every day, try to make me more money.
Yeah.
But I'll keep 5% in cash.
So I can buy more equity sometime.
So I can buy more.
Yeah.
Right.
Right.
And then, the industry was built around a particular mathematical relationship where they said, well, and look, and model portfolios are a phenomenal social good for the average investor because they combat two of our worst weaknesses, which is one is we tend to panic and sell at the bottom, and we focus obsessively on insignificantly small line items and how they did last month. Right. So getting people to look at their overall portfolio and map out what the horizon is going to look like in 10 or 20 years is hugely beneficial to tens of millions of individual investors. But underpinning it is a belief that you can't time the markets, right? You want to remain invested through good times and bad. And since you can't accurately pick whether stocks and bonds are going to do better this year, just keep it at 60/40. And then my point is that 60/40 was the right answer for 20 years. It has not been the right answer for this decade. It would be a lot more equities. Because in a sense, if you think about that 40%, right, the 10-year Treasury was yielding 50 basis points in the middle of 2020, 70 basis points by the end of that year.
Yeah.
Okay. So you were basically going to your clients at what no one argued was not the world's craziest bubble over the past 20 years. You're going to your clients and saying, we're going to put 40% of your assets into something that is sort of the equivalent of March 2000 with equities. And so
Treasury bubble in 2020.
I was saying actually the dot-com bubble in 2000.
But you're equating allocating to bonds at 50 basis points in yield.
Mm-hmm.
Now, a lot of advisors shortened up their duration, and their fixed income allocation is not always the same as a fixed income allocation. So I think a lot of people said, I'm getting paid the same for cash. Then I'll go to cash. I'll go to money markets and
that was a great move, right? Getting rid of duration was a great trade. Going to private credit was a great trade.
Okay.
Cliffwater, Steve Nesbitt, billionaires. Basically, he's become a billionaire under the argument that the public bond market is not giving you what it should be giving you. Anyway, my point is, when you look at the statistics, if you were to build a portfolio today, it wouldn't be 60/40. And so the problem is that going back to this connects to the disaster in liquid alts, and that's what's driving private credit ETFs and everything else. So people are saying we've got $10 trillion of ETF assets, of which the entire legitimate hedge fund ETF category is probably 10, 15 billion.
If that.
If that.
What, like a liquid alt that trades in an ETF wrapper?
Yeah.
I can't even think of more than 3 of them.
Wait, what is yours? Would you consider managed futures in that category? Yeah, right?
Yeah. So managed futures is one of the categories. Equity long short is another category. They've gotten certain, like long short factor stuff, like quant trading and other things. But it's not going to be the only solution, right? But the gold rush that you're seeing is, wait a second, that could be if even 3%.
Right. They always do that.
And so that's the way I look. So we manage an ETF that's about $1 billion too, right? Which you can look at it statistically and measure its benefits relative to a 60-40 portfolio, right? It's not a hard statistical argument to make. But we as an ETF are 1 basis point of the ETF world.
It's crazy.
So
it's a rounding error.
Exactly. So it's not, the argument is not get rid of equities, get rid of bonds, et cetera. It's just 40% is not the right number.
40% for fixed income.
40% in something that looks like the Bloomberg.
Well, listen, everyone seems to agree on this. So the only other than on the Boglehead forum, everyone in our industry seems to agree it's not 60-40.
Right.
It's 60-20, 5-5-5-5.
Exactly.
Or it's 60-20, 10-10.
Yep.
And then the argument is, well, what are those extra pieces going to be? And is that tactical in a certain interest rate regime? Do you say it's this and then you change? I mean, gold is over 3,000, so you're starting to hear a lot of people back to the gold sleeve.
Gold, Bitcoin, commodities, things like tactical things like managed futures, which we do, certain other kinds of hedge funds. People will, private credit.
MLPs they used to do.
MLPs, right. So people will feel, I think 60-20-20 is probably where most people are going to end up. And
what's the other 20?
Private credit, private equity.
All of your smorgasbord of things that you would consider to be not stocks and bonds.
But the active ETF industry just hit over $1 trillion or so. Balchunas is tweeting. So people like you and Simplify and Corey and people are allocating dollars to you guys.
Yeah, you guys have broken through.
But the active ETF story is an interesting one because active ETFs were a failure at first. Okay? Ironically, Cathie Wood was part of the catalyst of putting active ETFs back on the map, but because stock pickers didn't want to do active ETFs because they didn't want to disclose their positions, so they went down this non-transparent ETF route, which nobody bought.
She loved disclosing her positions.
Loves disclosing her positions. Yeah. Well, that's
now everybody. But you're right. Everyone realized, oh, all right, yeah, here's my positions. Who cares?
But there's $1 trillion.
We got in here.
Balchunas just noted that there's now $1 trillion of what are called active ETFs. A lot of those would have been called passive 10 years ago. It's a
they're active in name only. They're really quant. They're really quant formulas.
It's a DFA value versus something screening mechanism.
We call those passive, but I can understand why they would be sold as active.
Well, because when they were sold as passive, people would say, "Then why are you more expensive than Vanguard?"
Yeah, exactly.
And so now what happened is active ETFs has become a thing, and it allows them to price the active ETFs at 40 basis points and not get pushback. And now what's happening is across the industry, most of the ETF models originally were passive models because, a wealth management platform that had mutual fund models, they never really liked ETFs because they can't make any money on them. So they'd kind of relegate them and say, well, we have to give you an ETF model, but it's going to be passive. Or it's going to be, I think BlackRock's models are mostly like 12 basis points or something. So like the dirt cheap, super passive, super simple stuff to preserve the moat around the higher margin active stuff. Sure. But now you're seeing a convergence, right? So people are going to the same guys with the models and saying you need to mix it up a little.
Can we do this liquid alts train wreck chart? Walk us through what's going on here. You guys got this? It's chart 10. No, yeah,
this one. Okay, so this is data from February 2002 to December 2024. And what you see on the lower right, real estate, event-driven, long-short equity, macro trading, multi-strategy, those are the Morningstar category returns.
Yikes.
They're almost fully correlated to the S&P 500.
So the horizontal line is correlation to the S&P 500, and they cluster around 0.8.
Not good.
So what's the point?
And then the vertical's alpha, negative alpha. Right?
Horrible.
Don't buy them.
How long? Wait, Sam, write this down. Wait, for how long?
22 years.
But wait, not to defend that, but in a bull market, these things are going to suck.
Yeah.
Okay. Since 2002.
It might work exactly as you want, but nobody wants.
Would you pay 200 basis points for that? Right. It's not just they're expensive, they're complicated, they're hard to explain to clients. Anyway,
I would pay 200 basis points for that if they take me golfing at Winged Foot.
And they do.
Right. So then yes.
Right. And that's but that's a different part of the business.
I know.
Right?
I know.
I mean, you maybe should be so reformed.
So CTA replication and CTA hedge funds.
Okay. So
very distant from those at the other end. Why?
So CTA is a strategy where basically
commodity trading advisors.
Commodity trading advisors. It's a regulatory term, but what it basically means is people build these models that are effectively next generation charting. Okay, they're looking for breakouts. They're looking for the things that fundamental investors generally consider to be lowbrow. They just work well, and they've worked for 50 years. Now, what they do though is that sometimes they're long, sometimes they're short. So over a market cycle, if you look at that, they have no correlation. It's one of the few asset classes you can plug in and say, this really has no correlation to stocks. And by the way, it has no correlation to bonds either. And the horizontal axis is the amount of alpha it generates. So there's a $340 billion business of CTA hedge funds that do this. That are staples. $340 billion.
Did you know it was that big? That sounds that's a lot more than I thought it was.
Yeah. So the mutual fund side is only $20 billion.
Okay.
Right. In part because these guys walk in and they try to convince you to put your clients in something, and they basically are describing a leveraged long short derivative based black box, and they think your client's going to be happy with it. But the point is that even after high hedge fund fees, what that dot shows you, it's one of the few categories you can point to and say generates a lot of alpha. And alpha matters when you're putting together a portfolio. No one is going to give a crap about the alpha generation of a particular investment in a typical retail portfolio, but it is a way of looking at saying whether it should be. So when I look at CTA replication, the dot above it, what I basically said is, well, if they can do that after all these hedge fund fees, after all these crazy, what if we could find a way to copy that cheaply, preserve that's where we are in that vertical axis, and just bump it up? Okay. And if I can do that in a simple way, I can put it into an ETF. And then I can be the anti-liquid alt by actually giving you diversification benefits in a client-friendly wrapper.
And what's reception to that idea when you sit with wealth management firms?
If they want to add things to their portfolios that will bring diversification benefits, if they're in that mode, then it's very good. I mean, this is a breakthrough ETF.
So you don't position that against the S&P 500. You say, look, I already know you're doing. I already know you're doing that.
Right.
You're positioning that against the shitty liquid alts that they've been trying and failing with for 20 years.
I'm saying that 20% bucket that you need to fill.
Got it.
Look, I hope I don't get excoriated for this, but it wasn't my quote. He said, you're by far the tallest midget in that room.
Yeah. Right. We would excoriate you, but we don't know what that means. Would you like to be? All right. No, I love that concept. Let's put this demand for diversifiers chart up. I think this is good too.
Oh, so by the way, that's the growth. So we got into the managed futures. This was a non-existent space basically before we got into it in 2019. And again,
managed futures ETFs.
Managed futures ETFs.
Yeah.
Right? And you're the biggest by far, not to brag.
So I think I'm not supposed to talk about specific tickers, but whatever. So
you might get excoriated, bro.
But so what I wanted to basically do is I wanted to take this, which is valuable to advisors, and figure out how to translate it to advisors. Like the value proposition here is not some shiny object you can go to your clients and tell you about how cool this is. It's rather, how does this incrementally help your portfolio? Does it complement what you're already doing?
Yeah.
And so the space has gone from 0 to 3 billion. Now what's happened now is that people are realizing that out of that 20%, this is likely to be 3% of that 20%.
3% of the 20% that's not bonds and stocks.
That's not bonds and stocks. Maybe up to 5%.
So what's that TAM? Is that $500 billion?
I think this could be $100 billion.
$100 billion.
$100 billion space.
Okay.
Now what's happened is, since on the basis of our proving that this could expand beyond its original areas, it's about 3 billion right now. So 3 basis points in the ETF world. BlackRock just launched one.
Yeah.
Invesco just launched one, and Fidelity has one in registration. And what they're going to have to go out and do is, now every time you fire up Aladdin and do your asset allocation, guess what? Guess what's going to pop up? And it's not going to be BlackRock's track record in it. It's going to be the dot that you just saw about the overall space and its diversification benefits.
Got it.
In the same way that after they did IBIT, all of a sudden, oh, maybe we should have Bitcoin as an asset allocation thing. So the point is that my goal is not to compete with that $340 billion of hedge funds. It's rather to try to find a way to make this useful and valuable to advisors who are trying to find a way to help their clients grow their assets and sleep at night. basically, but message it in a way, because I describe this as the kale of asset allocation. You know what's good for you, right? And it could save you at some later date if you were going to have some nasty cancer come along. It's just not that pleasant at the time. It's not.
You're not going to right. That
strategy. It's not your tequila.
That strategy in 2024 is not going to be the thing that your clients are thrilled that they own.
Right.
Yeah. Right?
Low correlation, low fees are great when the S&P is in a 10% correction,
or even flat.
And
like
a 15-year bull market, it's tough.
Sure. Yeah, I mean the overall space is up 20% in 2022.
All right, guys, are private credit ETFs a bad idea? What do we think? PRIV got out somehow.
Somehow.
Did it get out, or it's
out? It's trading.
Out. It's in the world.
Yeah.
All right. I get the idea. Why should only rich people have access to private credit? Blah, blah, blah. They say this about everything. There's truth to that. I think regular people want to have the opportunity to invest in something that, I don't know, what is it compounding at? 12% CAGR for the last 5-10 years?
It's been a great investment.
It's been a great investment. So so I like the concept behind it. The execution is you have companies that are willing to stand and buy any and all redemptions. So if somebody wants to sell the ETF, they can, even though the assets are illiquid. There is a buyer who is under contract to take that asset to provide that liquidity. Is that how that works?
I don't think so.
So how does it work?
So a couple things. One is you can get access to private credit. You can get access through a mutual fund that's 100 basis point mutual fund that Cliffwater has. It's $25 billion. Thing is a straight line.
Straight line meaning it's gone up and up and up?
Up and up. It never goes down.
Yeah. But probably because they get to say what it's worth. But okay.
Exactly. Go on. No, I mean, one of the great appeals of private credit is the returns are fake. Right. It's like your house.
I love it.
So it's like private equity. It's like and it's people aren't pulling the wool over people's eyes. I mean, it's like if you don't really mark something to market. But so there are ways. The issue is in an ETF. So why in an ETF? In an ETF because there's $10 trillion of money that's sitting in ETFs.
That will only buy an ETF.
Will only buy ETFs.
Yeah, I agree.
And that's going to go to 20 billion or something, or 20 trillion or something. So what they're trying to do is jam illiquid assets. Now PRIV is controversial, not just because the SEC kind of said don't do it, but it's also controversial because it's State Street plus Apollo, except Apollo's not the PM. Apollo's job is to source private loans, basically.
Okay.
And sell them to State Street, who's the PM of this ETF.
Okay.
And
why is that bad?
Well, because
somebody has to do it.
Usually if your name is on the fund, you have a fiduciary duty to the investors. Again, the way I read it.
Oh, Apollo can sell its bags to State Street's ETF buyers.
That's the way I read it. Again, I am not.
Okay. That's the controversy.
But it's also but in order to get, there are strict limitations on how many illiquid assets you can have.
This show brought to you by Apollo. I'm sorry. I meant to do that earlier.
Okay. In order to bump the amount that they can have in private assets, it's only up to 35% of this.
Right. The whole fund is not actually in illiquid assets.
Right. And originally I think they were going to call it the private credit, and then the SEC said you had to put public in there. So but what Apollo has said is, look, we'll make markets in these loans that we originated.
That's what I was trying to explain. Right.
And in theory, that's fine on a normal Tuesday if you had to sell it and they were going to make a market for it. The problem is not that. It's March 20th, 2020.
Everybody wants out.
Everybody wants out. And there's one firm that knows how to price all these things. And they are the greatest distressed investors in the history of mankind.
Yeah.
And so I've used the analogy, it's like, it's so weird, some of the structural decisions they made. It's like basically saying, don't worry. I know all our money is tied up in this house, but our local vulture investors promised to buy it in the middle of a hurricane.
Yeah.
Like it doesn't, it's
also,
so weird.
But also, if I sell the triple Qs on it in a panic, right? Picture this, market's panicking, Sam's my client, Sam calls, says, get me out of there, triple Qs, whatever. If I sell them, I roughly know what I'm selling and at what price. Like I could look at Apple, Nvidia, Microsoft. Like I know the stocks that are big in there. I know the price I'm selling it at. All right? We all agree?
Right.
With this, get me out of PRIV. A, you don't know what you're selling. B, you definitely don't have a way to look up what the price should be. And that's the part of the asset class.
You'll sell it at a discount to NAV. That's not even a horrible thing to
You
me.
want
right?
liquidity, that's the price.
You have closed-end funds actually a mutual fund is at greater risk of having this illiquidity unwind because you go to the mutual fund and say, I need cash tomorrow, right? With an ETF, you're selling it into the market. So the great example on this is, people have always looked at ETFs with private assets, assuming that the ETF has to sell the assets to meet redemptions. It's not the way they work. They just trade in the market. The case study on it was the Greek ETFs in 2011. Okay, the Greek market actually shut down in the middle of the Euro crisis.
Remember this?
It was GREK.
It was my first year at Business Insider.
I remember you writing about the European debt crisis.
There was nothing else to write about.
That's all we did.
Yeah.
Okay. So what happened?
The ETF kept trading. It just traded a discount to the stale
NAV.
NAV.
GREK?
I don't know. Yeah.
Yes.
It was? You remember it?
Yep.
How old were you?
16.
But it's not disastrous. You sell it at below NAV.
Right.
It's the weird ways in which they've tried to jerry-rig this in a way that State Street has tried to jerry-rig. Because to me, they look like the patsy.
So people like you that get mark to market every day hate private credit. Hate.
Yes.
You just said the returns are fake. Let me play devil's advocate.
Uh-huh.
If you are making a loan to a company that is private, and you're going to loan them money, they're going to pay you interest, they're going to pay you back, why does that need to be marked every day?
It doesn't. No. I'm saying I should clarify. The volatility is fake.
The lack of volatility is a mirage.
But that's the point.
Okay, but
that's what investors are paying for.
It's exactly.
Yeah.
But now you have an ETF that trades every day.
Yeah.
Where the NAV doesn't move, but your price moves every day.
Yeah. Oh, I get why Cliff is pissed off. I totally get it. I'm just saying from the investor's point of view, good lie to me. I don't care.
No,
I don't want to see the market.
I used to get called by journalists about private in 2022. Private equity firms didn't mark down their portfolios very much relative to what happens in the markets, because generally they're leveraged long equity. So equity markets go down 20, 25. They should be down 30 or 40, something like that. But they mark it down 10, right? And journalists were up in arms. And they called me and they're like, they're deceiving their investors. So I called some guys who run PE firms and I said, guys, how do you feel about this? And they said, honestly, we don't really care, right? It doesn't really matter to us whether we're marking down 10 or not. He said, but nobody's pulling the wool over our clients' eyes. If we mark it down, if we're co-invested with Apollo, with KKR, with somebody else, and we mark it down more than they do, and our clients invest with us and not with them, they'll call us and yell at us. And if we don't mark it up in the same way they do, they'll call us and yell at us.
We're all in on it.
We're all in on it. I said the only people who care about this are journalists.
Right. By the way, and in 23 and 24, the PE funds did not have banner years. So yes, they may be undermarked down in 22. It's not like they were up 20. They didn't match the S&P in 23 and 24.
Right.
But and all these journalists, by the way, got their starts during the financial crisis, where everything
the FT hates them.
All the controversy
about CDS.
CDS and mark. I mean, it's literally mark to market was a huge issue back then, and accounting standards, were constantly changing, and it turns out that arguably changes to accounting standards help stabilize the market back then.
But Andrew, you're 100% right. Investors don't want to see the marks. That's why they're in the asset class.
Yeah,
but only if the marks are going up.
But if you're if you run a mutual fund company, you're in the asset gathering business. The thing that makes it easy to gather assets is when you look good relative to either your peers or the market or both. The thing that makes it hard to gather assets is when you look much worse. So there you are, going about your business. Market has a great quarter. You look really good. Market has a terrible quarter. Maybe you look a little bit better or a little bit worse. And that's the life that you have signed on for in that business. And then you see these other guys. In 2022, NASDAQ falls 30%, S&P falls 20%, Treasury's down 16, 17%. And these guys are down 5%.
Yeah, it feels unfair.
Well, they're going to raise a lot of money. Now, a quarter later on a lag, they may mark that down, but it doesn't matter. The money's already been raised. And so I think they look at it, Cliff Asness calls it volatility laundering. I call it regulatory arbitrage, which is what I think it actually is. But either way, it's got to piss you off.
It feels unfair. It feels it's bullshit. It's not fair. I get marked every day and they're f***ing lying. I get it. I'd be pissed too.
Right. I have a ticker
and
they don't.
Yeah, it's not fair.
All right.
So
it's not fair.
All right,
Investor. No. I'm not saying.
But you're saying they're not lying about the marks. It's just a different business.
That Cliffwater fund that I told you about, it's done 13% a year for the past since it launched or something. That's real money.
Everybody's happy.
Everybody's happy.
That's right.
And
except for Cliff.
But I think that again, I think there's a difference between. I think what's weird about this ETF in particular is the ways in which they've bent over backwards to kind of position them in a segment of the market that's clearly very, very hot, but just as an investor looking at it, it seems weird.
It's weird.
There's a built-in conflict. Is the easiest way to understand it.
Yeah, I called it like a moral hazard tied up with a bow. Like it's
how much money has this thing taken in so far?
$55 million. It just launched.
All right.
Is it going to have bad returns or is there blow up risk? Like, what do you see as the potential downside?
I mean, well, first of all, it's mostly going to be normal bonds.
Right.
I think just the question is, do people? I'm sure they'll do well. Like State Street as an organization, asset-wise, they're going to throw a lot of weight behind it. I'm sure they control model portfolios. The first, look, give them credit for being first.
Wait, will it get to $1 billion a year? I don't think so.
I don't know. Again,
that's a bold call, Andrew.
The ETF space, like I've come out and said and called certain things out there niche products, and people view it as an insult. JEPI from Morgan Stanley, from JP Morgan, is a niche product at $40 billion. JEPQ is a niche product with another $17 billion.
If you talk to somebody working in JP Morgan Asset Management, they will tell you JEPI is a huge home run.
It's the largest active ETF in the world.
Yeah. It's 35 basis points. Yeah. Right. So chew on that for a second. Right. They started with this thing being 35 basis points, but I'm saying it's not going to supplant the S&P 500. No. It's actually people are viewing it as. It's maybe feels a little more like that bond portfolio, the traditional bond portfolio that isn't working in the same way. I mean, I am all in favor of financial innovation, right? I am all in favor of bringing, and there's a lot going out there, particularly the ETF world, some of which is like Wild West stuff that we're going to look back on in 5 years and think, why the hell did people do that stuff? You know, the X-leveraged ETFs and single stock ETFs and stuff like that.
Well, we know why they did it. That's the spaghetti cannon. You don't know which of those is going to work.
Those are here to stay. Those are not going away.
But people buy them, right?
Yeah.
Like it's meeting some strange investor need out there.
No, gambler need.
Fine. I mean that's a need, right? I mean, putting the sugar in the tequila is like. I mean, if you need it. So
you know what? Those products have no marketing budget because Schwab and Vanguard don't make them.
Shit sells itself.
The shit sells itself. There are people using it and. They have their own reasons, and it's none of our business.
It's bottled lightning, right? And you got 5 of them.
Yeah.
And I mean, it's sort of a funny story. Like I took Matt Tuttle to lunch about a year ago, and it was before he hit the inflection point. And I was like, let me pay whatever. I'll pay for lunch. Be magnanimous, whatever. 3 months later, I was like, he has $4 billion.
Yeah.
Like I mean, look, he's an aggressive entrepreneur who has a great nose for sensing out the demands of a particular segment of the market, and he's going to build stuff for that. I don't think there's anything inherently wrong in that. Would I buy the products myself? No. Do I look at a lot of products out there that when you kind of get underneath the hood, do I think they're economically irrational? Yes. But I can make those decisions. But again, going back to the private credit thing, again, I don't think it's pulling the wool over people's eyes. It's what people want to see. The weirdness is going to be that the first private, like I would be more comfortable. There's actually the FT had an article this morning about a 33 Act fund that's going to try to have 80% of it in private assets from a bond box, and they basically say up front, and by the way, we may stop redemptions, right? Or you may not be able to get your money out because but again, that's like a private REIT. That's like all these other things. So in a sense, you're taking these things and just making them tradable in a different way. So anyway, yeah,
try it.
Yeah.
I'm just not looking forward to the moment where my friend from college is going to text me and say, "Hey, this private credit thing that I've been reading about in the journal.
Yeah,
I heard I can buy it now. Should I?
Yeah. Should I?" But,
and so I think
in this episode.
Yeah, I mean, exactly. That's what I've
been
ignoring.
You must be torn.
Time.
I wanted to ask you this. You must be somewhat torn though, because some of the best market research is now coming from private equity and private credit firms. I know you're a big Torsten Slot guy. Yeah. He's writing at Apollo.
Yeah.
Have you noticed a lot of the other strategists that you frequently read and quote. They're all going to private equity now.
Yeah, I mean, so I used to work at Yahoo Finance, which is Apollo owned or operated.
Yeah, that's right.
And so every day a newsletter, somebody's newsletter or something goes out where there's an ad for Apollo on it. Someone sends me a screen grab and says, "Hey, look at this! They're advertising again."
I mean, they're doing it. They're doing it.
It is not slowing down.
Yeah, I mean, I think Torsten Slok's really good. He's got really interesting charts and stuff, and then every once in a while he'll put out the private, credit deck.
Right.
And you're like, wait, hold on a second, what's going on?
Well, that's kind of the job.
Yeah. Oh yeah.
No matter where you work.
Exactly. That's all of our jobs.
All right, guys. Did you have fun on the show today?
The best.
Yeah.
Yes.
Thank you.
I could do this. I could do this for hours. I don't know if our listeners can though. So we're gonna leave it there. We always end the show these days by asking people what they are most looking forward to, and you could tell me professionally, personally, sexually. I almost don't even care at this point.
I'll let Sam go first on that one.
Sam, what are you most looking forward to, man?
I'm going on vacation tomorrow.
I knew you were going to pick option 3. Say more.
Yeah, I'm flying out to Aruba.
Aruba's sick.
Yeah. All right. Meeting up with some old college friends.
Awesome.
Which is great.
That's great. How many nights are you going away for?
4 nights.
Dude, you could do your thing mostly from there too.
Yeah,
technically, if
more
you needed
or less.
to.
Yeah. I've already sort of pre-written my stuff that's going on Sunday, but yeah, no, I'm actually looking forward to unfolding it.
Good for you.
Good for you, man. Happy for you. What do you got for us? What are you looking forward to?
It's embarrassing. Legos.
Okay, no, I want to hear it. Say more.
I got a 3.5-year-old. In my second marriage.
Okay.
2 daughters. They're one's
Wait, are you my age?
I'm 58 or 57.
Holy shit, you're
Yeah.
10 years older than me. Wait a minute, and you have a 3-year-old?
I have a 3.5-year-old.
So what's it like when you're like in the dugout at T-ball and the other dad coaches are hanging around? They're like,
I haven't gotten there yet. I've been away.
right.
Yeah, it's
that's gonna be
It's
fun.
an everyday reminder of the joys and wonder and amaze life.
Hell yeah.
And it's also a reminder that I'm older. It's But anyway, he loves Legos, and when I'm in the city, I get to raid the Lego.
Do you go to the Lego store in
Yeah.
30 Rock? Where is it?
It's right over there. It's
Okay.
right on Fifth Avenue.
That store is magnificent.
It's magnificent.
Okay.
And, yeah.
Does he have a specific genre of thing he likes to build, or he's too young?
Entirely automotive and preferably construction.
Automotive and construction.
Yeah.
That's so cool. Congratulations, dude.
And Legos are cool. When I was young,
doing Legos with my kids.
I love when I was doing. I mean, when I was young, I
amazing.
did Legos, but they're all just blocks, right? And you'd make stuff with it. The sets are so cool today, and the instructions are really cool.
It's also one of the only things that you do without a screen.
Yeah.
Like there's no screen.
I like
Yeah.
the zoning out part.
I love
Also, where like you have a mission, it's on paper.
it. It's great.
It's like a folded thing, and like 2 hours could go by for me, 4 hours because I'm not good at it. But like I love that like turning your brain off and just completing a side quest. I think that's like mentally healthy.
Yeah, you can see the progress. You can stop. You can. Yeah.
We're raising this boy in the 19th century, so
There
he's
you go.
this is about as exciting as his life gets.
Dude, that's amazing. Congratulations.
Thank you,
Michael. What are you looking forward to? You were celebrating your birthday for a 4th or 5th time tonight.
Yeah,
That's
happy
pretty cool.
birthday, man.
I'm excited to go to dinner.
All right.
So we're going to Emmy Squared. There's a new one in Hell's Kitchen apparently.
Yeah.
Oh yeah, yeah.
We love
the
that
pizza
place.
Yeah.
And burgers.
Oh,
Pizza and burgers.
We're big fans.
So I have a nutritionist now, and I got to give her the heads up when I'm going to go do something like that.
So Josh has been talking about his air quote nutritionist
What do you
for
mean
the
air quote?
hang on for the last like 2 months. Apparently, it's a real person. I thought he was fing around.
No.
Yeah,
What do you think? I make things up?
I did. I thought you made it up. This person exists.
So I start showing her the Instagram for Emmy Squared, and she's like, "Oh my god, now I want to go." It's Detroit style pizza, and I'm a New York style pizza
Detroit-
partisan.
Detroit
It's
style.
It is so goddamn
It's so
good.
good.
So we're going to Glengarry Glen Ross tonight,
Oh, nice.
and right across the street from the theater on Broadway is Emmy Squared Hell's Kitchen. So I was like, "Yeah, we have to do that."
Gotta do it.
Nice.
Do you watch Daredevil?
No.
Okay.
Should I?
I thought you would. I like it. Good show.
I watch a lot of shows.
It's
but
fun.
Not that one yet.
Is there a new Daredevil show?
One again. It's very good.
Okay.
So the last one is
Oh
like
yeah,
the
with
last one's
Vincent
like
D'Onofrio.
They
The
brought
last one's-
everybody back from the Netflix series.
wait. You watch it,
Yeah.
dude? It's awesome. It's not as good as the first one, but it's 8 years old.
The movie.
It is. I like it. No, the first one was better.
I like the first one
But
better.
that was
too.
2017. It's a long time ago.
Yeah.
I
struggle to
had
keep
Daredevil
track of
100.
the-
I had Daredevil 1 through 186.
Okay.
From when I was
nice.
collected
I have
when
a
was
lot
young.
of those, but I don't have the whole
And
run.
look, I was born in New York.
Yeah.
Had glasses and I had red hair, so it's like I had to like Matt Murdock.
What was your store? You go to Midtown?
I went to the one on was it 51st, all the way on the east side.
On Lexington.
No, there was one. It was almost like between first and second.
Sutton Place.
Something. It was. I forget. It was far over there. But
Okay.
And then the first movie came out with Ben Affleck. I was like, you ruined the value of my collection.
Yeah,
It
It's the worst. It's the
destroyed.
worst I've ever seen.
It's not bad. They took the Netflix actors and moved them over with only slight changes.
Josh is right. It's not as good, but it's awesome for me. I have a good time.
Yeah, no, I think it's fine. I think it's fine. And actually, if the first version never existed, you would love this.
True.
There's some MCU threads that I'm a big fan of, and some that I just can't keep up with. But I remember, I don't know if you saw Hawkeye.
Yeah.
That it like took place.
It was
in
like
Europe.
a Christmas special.
It was a Christmas thing.
Yeah.
And then at the very end, like the epilogue after the credits had Kingpin walking in the background.
So I like when stuff like that happens, but then they didn't do anything with it.
Yeah, maybe is this it?
Oh, dude, how about this? They had John Bernthal playing the Punisher and somehow didn't make a movie out of it.
But John Bernthal's in the an accountant too, by the way. So that's why you have to catch up on that movie.
Big Bernthal guy.
All right, guys, this has been amazing. I want to say thanks to the crew, Duncan, John, Nicole, Rob, Graham, Keith, Travis, Daniel. How'd I do? Sean, Chart Kid, Matt.
Pretty good.
It's
Wow.
crazy. You guys killed it this week. Views are through the roof. Until this episode, we'll say. No, just kidding. All right, guys, we love you so much.
Good.
I want to tell people how they could follow you, how they could find your stuff. Sam, let's tell everybody how they could find the ticker.
Yeah.
And they should be subscribed immediately, in my opinion.
Yeah, it's ticker.co, TKER.co.
Very easy to find.
Very easy to find. Sign up for a free subscription. Shoot me a note. Say you listen to the compound. I'll send you some free.
How many notes
free
you?
months.
How many notes are you publishing each week?
Yeah, somewhere between 2 and 4.
Okay.
Josh
But
is
every Sunday a free one goes out.
Josh is at MAGA Josh on Truth Social.
Yeah, find me on Truth Social.
The real MAGA Josh.
Josh the Tariff Man.
That's right. Mr. Beer, tell us where we can learn more and follow your thoughts.
Well, our company website, if you're interested in what we do, is www.dbi.co.
Ticker DBMF. I could say it. You can't.
I cannot say it.
DBI.co.
CO. So no
Oh,
M.
just like
Yeah,
him.
Yep.
Okay.
And
That's the future, man.
if you, the commentary they do, I am on a sabbatical from Twitter
Good
for
for
my
you.
sanity. But I
Me
am on
too.
LinkedIn.
You know it'll be 5 years for me in May?
Okay, God bless you.
Yeah. I deleted the app from my phone 5 years ago.
Did they give you little?
I sent
medallion points?
I sent 4 tweets this year.
I
That's
I couldn't take it anymore. So I'm on LinkedIn. If you look me up, please reach out. I respond to everybody, and anybody reaches out to me, I respond. So
Yeah. LinkedIn is where non-sociopaths spend their time, and it has its own problems.
You know what happened with me on Twitter was that for some reason on my feed, I started to see industrial accidents.
Yeah.
And
get
it
off
was
that
just
shit.
macabre, and I was like it was nauseating.
They
So-
keep showing it to you because you keep watching it. All right, guys, that's it. We're going to wrap up. Special thanks to our listeners and viewers. We love you. See you next time.
Thank you.